Go ahead, Steve.
All right. Well, good morning, everyone. I'm glad that you can join us this morning. Hope you all had a chance to get out and shovel the snow and clear the sidewalks. You may want to certainly keep your video off if you want, and we will have a chance for questions. So as you have questions, please feel free to chat those to us. And I don't think I said who I am. I'm Steve Moyer, and I'm the tax director here at Canon Capital. And Brent Thompson is going to be joining me doing this presentation. For those that haven't been with us before, welcome. And I just hope that we can give you some information that you'll be able to use. I believe there's a lot here, and we're going to be pushing to get through it. But we believe it's really important for you to hear and understand this topic of the employee retention credit. So you can take a look at our bios, and we're not going to say much more about us, but we just want to make sure that you know that the information that's included today is current, but as with all of the other items that have come out from the pandemic relief, there's been a lot of changes. So just be aware of that there's IRS needs to give us some more guidance on some issues, and we will try to keep you updated as things change, but for now, everything is up to date as of yesterday. There could be things that come out as we speak today. All right, so as I said, we believe this topic is very important, and it's probably been a topic that's been underreported and taken a back seat to the PPP loans, which probably everyone's heard about. And there's a lot of money available here through the employee retention credit, and we want to make sure that you know how to get it. And we'll just go through some of the guidance. There is so the employee retention credit came out back in March when the CARES Act was passed, and again it came out along with the PPP loans. And at that point in time, you could not take the credit if you were going to take a PPP loan. So as the year went, there was all kinds of other tax laws that came out, and then finally at the end of December, this new tax law was signed. The Consolidated Appropriations Act was signed on December 27th, and it made some changes that we're going to go over to the 2020 employee retention credit, and also to the new 2021 employee retention credit. So there's kind of two pieces here, and over the 2 years, and we'll describe the differences. So we're going to look at the eligibility, how they interact with the PPP loans. We're going to go through some examples. Then we're going to look at 2021 and look at the changes that occurred, and tell you what the qualified wages are and the eligibility requirements. And then at the end, how to claim the credit. And one thing to keep in mind, that this is a refundable credit. So in other words, if you have tax of, let's say, $5,000 and you have a credit of 12, you can get that $7,000 difference refunded to you basically in cash. So keep that in mind as we go through this. All right. So there's a lot of rules and requirements here, but so some of the things that are beyond today's presentation, we wanted to just focus on mainly our client sizes and most of you as attendees, the size of your businesses. So there's some special rules for over 100 full-time employees. That's in the new, they came out with, you know, the 2 different years. So there's 100 full-time employees, 500 full-time. So the larger businesses, we're not going to really cover anything that's over that. There's aggregation rules for, you know, if there's multiple companies and they're all kind of interrelated. We're not going to go into all those details. And then there's also attribution rules for related individuals to the owners. So we're not going to go into all those details because we just don't have that kind of time today. And then there's special rules for new businesses that were just started in the last 2 years. So we're not going to go into those that deeply either. All right. So now I think Brent's going to get right into the 2020 rules.
Yeah, thank you, Steve. I just want to thank everybody and sort of apologize for the vetting questions at the beginning. We're dealing with a much smaller topic today in a way, so we're not expecting our usual audience of 80 to 100. But as Steve said, this is really going to be impactful. And what really happened was that law that was passed on December 27th really threw a monkey wrench in the works. Good for taxpayers, but that's what's kind of necessitating all this. I did actually go back and look. Our first PPP presentation, for those that are, this is your first Canon Capital joining us for a Zoom meeting, Steve and I have given 5 or 6 presentations, I believe, to this point. And we did cover the employee retention credit back in April, but again, this didn't get a lot of press because it didn't play with the PPP loans. So now you can go back and play with the PPP loans, and that's what we're going to get into here a little bit. So the employee retention credit for 2020 was a credit of 50% of wages up to $10,000 of annual wages per employee. So therefore, then the credit that you can have refunded is $5,000, and this is for wages paid on or after March 13th, which was the effective date of the original CARES Act. Even though the CARES Act was signed at the end of March, the effective date was March 13th. For 2020, you'll have to qualify for each individual. Employees would need to qualify in 2020. And again, the $10,000 in wages can be paid over different quarters. And again, related party compensation, we have a couple appendixes today, just copying the IRS frequently asked questions. So, but 2 other important things here is this credit's non-public. So your PPP loans are public information if somebody wants to go after and find that. And this is not. And you don't have to submit anything to the IRS to prove you're eligible for this. So what could possibly go wrong? here. But that is an attractive part for a lot of people that, again, don't want to be burdened by paperwork and stuff like that. So the original 2020 rules, again, excuse me, employers of any size, including nonprofits, were eligible if one of these two things. If your business was shut down by some kind of government order, which is federal, state, or local, either fully or partially shut down by a government order, or your business has had a greater than 50% decline in gross receipts in a calendar quarter in 2020 as compared to the same quarter in 2019. Now, these are calendar quarters, January, March, April through June, July through September, not a 3-month period, it's calendar quarters. And you have to have over a 50% decline in gross receipts. We'll talk about what that is in a few slides. Important to know here, the reduction does not have to be COVID related. So you can lose a major customer and you're still gonna qualify for the retention credit here. So you do not have to prove that it is COVID related, all right? What was the death blow was, again, if you were taking a PPP loan, you could not do this employee retention credit. And you'll see the employee retention credit has some what ifs and ifs and ifs and ifs, whereas the PPP loan was billed as free money, right? So, and a lot of times the PPP loan was a lot larger dollar amount potentially. So, and that got all the press and all the, everybody running after it. You know, the money's going to run out, and it created more urgency, you know. So this, again, as Steve said, this didn't get a whole lot of press. It's still, to this day, not getting a lot of press. But it's just as about as free money as the PPP stuff is, if not even better. Again, because reporting requirements, public knowledge, things like that. So, and then it's important to note that your tax reporting method is what you use to measure the decline in gross receipts. So if you're on the cash method, you would use cash method to determine. If you're on the accrual, you would use the accrual. All right. If you did qualify through a government order, the only wages that were paid within that period of time were the only wages that would be eligible for the employee retention credit. So if you were shut down, you know, pick random dates, you know, August 13th to September 23rd, that's your period that you would qualify for if you qualify under a government order, all right? If you qualified through the reduction in gross receipts, you have the full calendar quarter. So if you're, and we'll have some examples of this coming up, but if you had a significant decline in gross receipts for the second quarter of 2020, which was right smack in the middle, right? So April, May, June, everything was shut down towards the end of March in Pennsylvania. So the second quarter was really where everybody took the hit. So you're eligible in that whole quarter from April 1st to June 30th. And you will remain eligible until you get to the end of a quarter where your gross receipts exceeded 80% of the gross receipts in the same quarter of 2019. So inherently, if you qualified for any quarter in 2020, you had at least 2 quarters. You had one going in that you qualified for, and you at least have one coming out. So if you qualified second quarter, inherently you qualify for the third quarter. You have to see how the third quarter does, and then you may be eligible for the fourth quarter. If, and I have a couple clients in this fact pattern, but if you qualify for the second, The third is over 80%, so you're done. You cannot go back and again qualify for the fourth quarter if the fourth quarter is under 50%. So for the 2020 credit, and we'll get into the fourth quarter as it relates for 2021, but this is how the 2020 rules work at this period of time. So again, pretty much the only thing that's new is as the passage on December 27th, you can now do both the PPP loan and get the employee retention credit, not only for 2021 going forward, but retroactive for 2020. So on December 27th, they passed and said, oh, yeah, you can go all the way back to March and work things up as if this had always been law. And that's what's causing a lot of delays, if you will, for CPA firms because, you know, jumping ahead a little bit, but we can't do year-end work. We can't do you know, a lot of things until this particular subject, the ERC, how it plays with PPP and all that is worked out, at least on some kind of broad level. And again, for those that have joined us, you know, we've used this phrase, but we're building the bridge as we're walking on it. So there's not a lot of guidance out there yet because remember, these two could not play together before December 27th. So we're only about 6 weeks away from the 27th, I think. So, you know, we're going to be waiting for some guidance to come out. So, Steve, do you want to walk through some examples of government orders for us?
Right. So yeah, the government orders. So the two ways to qualify is the decline in gross receipts or being closed down because of a government order. And so this wording on this slide comes directly from the IRS FAQs that they put out back in June of what a government order is. And so it's a decree from any federal, state, local government. If they limit, you know, commerce, travel, meetings due to COVID, that affects the employer's operation of its trade or business, including limits on hours, and you know, limits from the state or local government that affects the employer's operations. So I think that last piece there had a couple repeats, but anyway. So some examples of what government orders might be. You have a city mayor that requires all non-essential businesses to close, state emergency proclamations that residents must shelter in place, other than those working for essential businesses, local officials imposing a curfew that affect the hours of operations. So instead of being able to be open till 9 p.m., you have to close down at 5. And then health departments also mandating workplace closure for cleaning or disinfecting. So you might have a business that has 3 shifts, and because they have to clean and disinfect, they have to close one of their third shift down to be able to clean and disinfect all the, you know, pieces of equipment and surfaces and all that kind of thing. So this wording in this piece comes from also another IRS FAQ, number 30, and I think there's probably 7 or 8 of these relating to government orders, possibly 10. But so a full or partial suspension A partial suspension is not a demand concept. Just therefore, if there's no customers because of an order, that doesn't qualify as long as if the business was able to be open. Teleworking is also not a suspension. If your business is closed, but your employees are able to work from home. Operations must be able to be continued in a manner comparable to operations before COVID. Modifications to operations must have more than a nominal effect on business operations. So we'll go into some of these. So here, this last piece, we talked about aggregation rules. So if you have an aggregated group, if you have an aggregated group and one of the businesses, so you have 3 different business entities, and one of those businesses had to be closed down, it affects all the other businesses also, and that they would all be eligible then. All right. So like I said, the IRS issued these FAQs back in June when the first employee retention credit came out after the CARES Act. So we're anticipating that they will also provide us with more FAQs on some of the different new nuances. But some examples here on what are suspensions. So local officials impose a curfew that impacts the operating hours of a business for a specified period. That business then would qualify. So I think I already mentioned that, you know, you have to close your business at 5 and your normal operating hours are till 9. You then qualify for a partial suspension. Company is open, but customers are under a stay-at-home order. The company would not qualify for the suspension because they're open, but obviously you may qualify under the decline in gross receipts if your customers can't come in through your doors, and you don't have any online activity or anything like that. Restaurants, we all know the issue that restaurants have been going through. They're a prime candidate for the employee retention credit just because of all their changes. If they've closed their in-person dining and still permitted to provide takeout, they're going to qualify because they can't continue their operations the way they had in the past. If they're, you know, permitted to only have 25% people coming through their doors to sit down, they're going to qualify. So there's a lot of, you know, restaurants, gyms, places like that. Daycares would also fall into something like this. Last example here on this page, a law firm is closed due to government order, but the employees are teleworking. The law firm then would not qualify for a full or partial suspension because they can continue their work similarly to what they did previously. One item that's not on this slide, and I think it's important for an example, because I think it may fall under the area of thinking that they were able to do their operations the same as they had in the past, and that's for a church or even a not-for-profit school. So so you think about churches, many churches were able to adapt and have their services online. But some, you know, some language here. A church really has other pieces other than their normal, you know, Sunday morning service. They have their children's classes, their different ministries that people couldn't come in for. So, you know, we believe that they're going to qualify also, along with you know, not-for-profit schools, because even though you could have school online, you can't have the athletics, you can't have the other extra, you know, curricular activities that you could previously, your band, your music, things like that. So while, you know, these areas of the government shutdown are areas where there's a lot of leeway, I think, if you will. And it's an area where we're going to need to be involved with you in helping to make this determination of whether you qualify under this. And I think, you know, the decline in grocery receipts, like I said, is pretty straightforward, but this area opens it up for a lot of businesses that maybe thought they didn't qualify. So we need to understand, you know, your business, your operations, and have those conversations in this area. So just to, you know, keep that in mind, that this, you know, takes a lot more than just, you know, crunching some numbers. All right, so gross receipts, what are they? And we need to know this definition so that we can find out if your gross receipts declined. So for a for-profit business, they would be your sales net of your returns and allowance, plus any, you know, investment income. You know, if you had some cash set aside in some mutual funds or whatever, you had some gains, interest, dividends, any rent, royalties, annuities. You had to sell some assets that you were no longer using. Well, that would be, you know, your gain on those assets. So you would, your cost minus your basis in the assets. So think of about anything that would be a taxable type of receipt. Not-for-profits would also include all of the investment income type items. They would also include contributions, gifts, grants that they received, and member dues. You would not include any loan proceeds, any forgiveness of your PPP loans, or any other non-taxable income. Just keep in mind that, you know, we can't cover everything here, so this isn't necessarily all inclusive, but it's a guide. Okay. Let's see. So here we have a little example to show how this would work for 2020, the significant decline in gross receipts. So the top line, you can see by quarter, calendar quarter, as Brent mentioned, January through March, April through June, etc. You have the 2019 numbers. So you have 400,000 receipts for the first quarter, January through March. And then you compare that to your first quarter of 2020 receipts. The receipts are down, but only by 10%. So that's not going to qualify. You have your next quarter then, 500,000 in 2019 were your receipts. You had a significant drop in that quarter. So now your drop of 60%. And so on. You can follow the numbers. So your decline in gross receipts begins in the April through June quarter because you had that larger than 50% decrease. And then it continues into the next quarter. So July through September. So you would have eligible April all the way through September, because in the third quarter, July through September, your receipts now are back up and above the 50%. You do not qualify then for the fourth quarter. However, because the fourth quarter then is back above the 50%, you can then qualify for the first quarter of 2021. So that's kind of what that little chart shows there.
All right, so I'm going to work through an example really quick for 2020. So we have a restaurant that's been shut down, not operating at limited capacity from March 19th to June 1st. Now in Pennsylvania, it was March 19th and we're still at limited capacity. So if you're a sit-down restaurant, you basically qualify from March 19th through December 31st, I believe, in the state of Pennsylvania. But for our example here, June 1st, all wages are qualified. So that is, there's no Families First wages or other government reimbursements or any other assistance for COVID, if you will. Restaurant has under 100 full-time employees. We're not talking about large businesses here today. And the restaurant did not have a significant decline in gross receipts for second or third or fourth quarter, but let's say they did for the first quarter. All right. So as a result, the wages paid from March 19th or 13th, excuse me, to June 30th will qualify for the ERC, for the Employee Retention Credit. And why these dates? Why March 13th and June 30th? Okay. Well, there was a significant decline in gross receipts for the first quarter. So the January through March time period would qualify, but remember, we only can take from March 13th on. So even though the government order didn't come in until the 19th, we qualify because of gross receipts back to March 13th. And then again, same on the back end is the government order ran out on June 1st, but because we qualified for this second quarter, we can go all the way to June 30th. So you have to watch why you're qualifying, all right? But you would definitely qualify for the March 19th to June 30th period. It's just because we had that significant decline in receipts that threw this example off a little bit. So just wanted to go over that. Now we're going to continue. So we're going to say 15 weeks here. So what does this look numbers wise? So if the restaurant has 4 employees, and we can see their weekly pay here. Now excuse me, we haven't talked about this, but the net cost of health insurance for the employer would qualify. All right, so any of your group policies would also qualify as wages paid, net again of their withholding or their reimbursement portion of it. So we have their weekly pay in wages. We have the health insurance, and then it comes up for the total pay for the week. All right, so, and then we have the 15 weeks in our example. So here's what you paid over that 15 weeks. All right, but remember there's a limit of 10,000 for the annual. All right, even though we went over quarters, we are capped at 10,000 for an annual figure. And so Al is capped and Chris is capped. And then here's your credit. So again, this is large money. If you look, we had over this 15 weeks, we had 40,000 in payroll, and we have a $12,000 refundable credit that we can now claim that we were not able to claim before. All right, and that's almost 25, well, not almost, it's over 25%. Someday I'll do math. So this is significant, and we'll show you some more examples. The first two, I mean, just to give you reference, the first two that I worked on, you know, business of 30, 40 employees or so, we're talking, I was 127,000, and I think that was the smaller of the two, if I remember correctly. And then there was 100 and some odd thousand for the other one that I worked on. So we're talking like serious money. And keep in mind, this business in our example, they may have received a PPP loan, all right, of approximately 29,000 here. So if we take our weekly pay, you know, figure 2.5 months worth, that would be about 29,000. We had a 24-week period for our PPP covered period, and then which would give us about 64,000 in wages. All right, so our weekly times our covered period, and of the 64 in wages, 24 here goes to the ERC, which then would leave 40,000 to get forgiveness of the 29,000 of PPP. So here's the point. We'll talk about the ordering rules and stuff a little bit more in a minute. But here's the point is because you have a 24-week period for your PPP loan, and you should have plenty of payroll to actually cover both of these. And even if you don't have enough payroll, then you can go into other costs like rent and utilities and covered expenses and stuff for your PPP. Again, we'll expand on that a little bit, but again, this is significant. In addition to the PPP loan, you're getting over 25% of your payroll basically reimbursed for this 15-week period here. Numbers may be a little bit small. I had to cut off some zeros to keep the number of columns here, but it works. You know, it's all relative here. So, all right. A second example. So the same facts in example one, except the employees now here above, there's only two. There's a significant decline in gross receipts for second quarter versus being shut down. So we have the second and third quarter. So let's say we came out the third quarter, we exceeded 80%, and now we're not eligible for fourth quarter of 2020. So here's a very part-time person, two part-time people. Here's their total wages over 26 weeks. And again, we're capped at 10. So each of them have a $10,000 qualifying wages, and they'll each get, the employer gets a $5,000 credit. So here on 35 of payroll for 26 weeks, we're getting reimbursed 10,000, which is a third. okay? So again, a lot of part-timers is basically going to increase the credit proportionately to your payroll here. So again, we are talking significant amounts of money here if you qualify. So I said I would talk about the order here. This came out, the order of priority is the family's first wages. So that, as a quick reminder, if you have to quarantine or you have childcare issues or your school or daycare is closed, everybody had paid time off, either sick or family leave. Even the smallest of employers, if you had one part-time employee, they had qualified family and sick time through this Family First Act. So those wages get reimbursed, so they're not eligible, all right? Then the order is the next dollars of wages that are paid go towards the employee retention credit. And then finally, then they go towards PPP loan forgiveness, all right? And you can't use the same wage for any two of the three items above, all right? So a couple planning points, and I've had this with a client of mine. You may want to consider taking less PPP2 money if you qualify for both the ERC and the PPP. Again, this is if you have lower part-time employees, they're going to use up all the ERC and not have any towards the PPP forgiveness. Now, that being said, you can make an election to have the wages apply to the PPP first and then the ERC. So we can mitigate that a little bit. But the other, which was quite interesting, is you may want to wait for PPP2. There's no reason to rush out and get it now because there's plenty of money, and it's not the situation that we had with PPP1. We get updates from the AICPA over the last couple of weeks. We get a weekly update. They talk directly to the SBA and to Treasury. There's no rush right now. So we can wait. And then what that does is that lets the 24-week period go past June 30th of this year. So we didn't get into 2021 yet, but 2021, we have the ERC for the first or second quarter. So if we wait to get PPP2 until sometime in March, then that 24-week period that we can use would go well past June 30th when the ERC runs out. Okay, so again, you just have to be careful. So just really quickly to kind of illustrate it, what I just said is you may have gotten a PPP loan right around April of last year. Okay, so your year looks like this. You had ERC that you're maybe eligible for, then you have a block of your PPP loan, and then you have a block at the end of the year after your covered period ran out that you're, again, fully eligible for the ERC. Again, the first 10,000 of wages in the ordering rules have to go towards the ERC. So you may have somebody not working for you, but they didn't make 10 by here. So they may go into the PPP loan, and you may have somebody with the ERC wages priority in the PPP loan period. You can have a new employee that starts, and they, again, their first 10 go towards the ERC, and then they may have to go to here for PPP, right? If they exceed the 10,000 here. All right, you may have employees come in after the PPP and they're just totally ERC qualifying. All right, so you have to kind of frame this out mathematically and track wages. And this isn't, I don't want to say it's not easy, but again, there's a lot of there's a lot of pieces that we have to put together, especially with employees that are coming and leaving, and maybe they didn't make their 10,000 and then they go into the PPP range, that you have to finish out the ERC before they're eligible for PPP money. So even though that your calendar looks above the blue arrow here, the reality of your tracking is going to be a little bit all over the place. But you know, we can build spreadsheets or trackers for this. So just be aware of that. Okay. I forgot, we don't have any questions yet before I turn it back to Steve. You know, again, if you have anything, you know, feel free to chat it in and we'll take that up. But so Steve, I'm gonna give it back to you.
All right, thanks, Brent. Yeah, so the title of this slide is if your application, your PPP loan forgiveness application was filed. Let's step back before that. And if it hasn't been filed yet, we suggest that you hold off. There's no rush to go out and file that PPP forgiveness application at this point, because we need to, just as Brent's last timeline shows, we need to get this, get it figured out how the dollars interplay with each other. So, and we've been, for those of you that have been on here before, we've been trying to say, hold off on filing those forgiveness applications. Just there's no rush. We have plenty of time to do that. So that's what I would say first. But I know that, you know, there's many banks out there that are pushing people to get their loan forgiveness applications in. And if you did, what can we do here? You know, and because the rules changed so late in the game, December 27th, and it affected retroactively back to, you know, March of last year, many people that did those applications early may have used all of their wages on the PPP application. So then what happens? The new law came out and said that, you know, you can use some of these other expenses. Well, I mean, you could use them before, but many people didn't. It just was easier to qualify with the wages. So, for example, you had a $500,000 loan and you used all $800,000 plus in wages, but you didn't use any of your other eligible expenses like rent, utilities, and that kind of thing. So, you know, right now you can't claim the ERC for any of the wages reported on the application, even if there is an excess. However, the AICPA a few weeks ago has, you know, sent letters into the Treasury asking that those excess wages that you didn't need for the PPP forgiveness, you can now use those for the ERC. And then if you need to apply some of those additional costs against the application, that we're still, you know, that's one of those things that we're waiting to hear back on. So if your application was just recently filed with your banker, you know, you might want to go back to the bank and say, hey, can I pull this loan forgiveness application back out and then make the changes to the forgiveness application? That still may be a possibility to do as well. All right. So the ERC 2021, it gets much better than 2020. So there's a lot more dollars available here than even Brent showed you in 2020. So first of all, it now allowed the PPP borrowers to claim the credit for both 2020 and 2021. Just claiming the credit. Let's see. So the qualified wages, yeah, okay. So the credit for 2021 goes through June 30. So there's 2 quarters available. The qualified wages per employee are still the 10,000, but it's 10,000 per quarter. So now you have 20,000 per employee potentially, and the credit has increased from 50% of the wages all the way up to 70% of wages. So you know, you're getting 70% back of the wages that you pay to your employees, you know, up to $20,000. The decline in gross receipts has dropped significantly also. It's now only 20% versus the 50% that it was back in 2020. And this 20% is still calculated in regard to looking back to 2019 gross receipts, which gives you the ability to use the higher receipts, you know, potentially if you lost, you know, income in 2020 because of the pandemic. And then the 30-day look back period is eliminated that we showed you in the earlier examples. So you don't have that look back period any longer. So eligible employer, so you have to be a business, you know, whether it's a sole proprietorship. If it's a sole proprietorship, you have to have employees. It can be a partnership, S Corp, corporation, not for profit, but it cannot be a government entity in 2020. 2021, same thing, employers of any size, including tax exempt organizations, colleges, universities, and hospitals now qualify. And, you know, you can be a PPP loan recipient.
All right. For the gross receipts for 2021, we had said there has to be at least a decline of 20% of gross receipts, again, compared back to 19, which is, again, very advantageous. And then, or you can compare the preceding calendar quarter to the same quarter in 19 to determine if you're eligible or not. So for example, the first quarter of 2021, which we're just going into, you can qualify for that quarter based on the comparison of the fourth quarter of 2020 with 2019. So if you had over a 20% reduction in the fourth quarter of 2020 compared to 19, then you're set up and you're qualified for at least the first quarter in 2021. Now, there are some questions if you make that election, if you will, to compare the preceding calendar quarter. I don't know that it's clear yet when you get to the second quarter, whether you have to use the preceding quarter still, that you're locked into that, or the second quarter of 2020 could stand on its own. So again, you can use the actual calendar quarter in 2021. We get to March of 2021, you compare receipts and find out that you qualify. You can go back and retroactively get the credit, and you can do that the same for the second. Or if you know now that you can qualify based on the previous quarter, you probably want to do that and have the credit calculated as you go through the first quarter. I'm just not clear what happens at the end of the first quarter for the second, whether you have to keep that previous quarter election, or if you could get to the end of the second quarter and claim it retro as well. So again, it's all based on receipts. So if you're close, keep that in mind. Qualified rate, wage and credit rate. Steve had gone through this. It's at $10,000 per quarter now, and the credit rate's up to 70% of qualified wages. And again, special rules for large employers, seasonal stuff like that would also have to be taken into account, but not on our meeting today. Steve, you want to walk through the examples here for 2021?
Okay, so yeah, first example, we have a business that's been shut down because of a government order, operating at a limited capacity for 3 weeks, February 1st through February 22nd. All wages are qualified wages. The business has under 500 employees. So keep in mind, back in 2020, the number of employees was 100 that you were looking for. That has expanded to 500 in 2021. There was not a significant decline in gross receipts for the fourth quarter of 2020. So we're looking at wages for the credit of from February 1st to February 22nd that are going to qualify. Again, we can look through the example. We got 4 employees here. First person has health insurance that was added. And keep in mind, because this business was shut down, if let's say one of these people didn't get paid any wages, but they still had health insurance that the employer was paying, that health insurance counts as their wages also. So they don't have to have pay to count the health insurance. Just wanted to point that out here also. So you can see the total pay for the 3 weeks totals $8,040 down in the total column, and based on their wages, none of them reached the limit of 10,000, but they were able to get a 70% credit of $5,600 on $8,000 worth of wages. And keep in mind that if this business is applying for the second round of PPP, they can also get that, and use those PPP funds for, wages paid for outside of this time frame. All right, so we have a second example. This business has a decline of gross receipts for the second quarter of 2020 of 60%. Third quarter, they declined. Third quarter of 2020, they declined at 32%. So they're under the 50% there. And fourth quarter of 2020 of 22%. In 2020, they had under 100 employees. Business has 4 employees who the business claimed 5,000 credits for each employee through 2020. The business elects to use the decline of over 20% for the fourth quarter. So they were at 22% to make them eligible to claim the first quarter of 2021 eligibility. And then, so we can go over to actually see how this played out based on this business. Again, 4 employees. They were eligible, again, because it was a decline of gross receipts. There's no time period limit. So for the whole first quarter, 13 weeks, they were eligible for those wages. So the total wages for these 4 employees were 104. A number of them are over the $10,000 limit, so we have to limit it to 10. And so you can see on 38,000 of eligible wages, they were able to get a $25,000 credit. And the difference of the other wages then can be used for PPP if they have a PPP loan. Let's see. Yeah, so that was pretty much what it says in the summary there. So you can see these dollars can be significant. And again, you have some employees here, like for example, Brad and Al for sure. If you remember from the PPP loans, any employee that earns over $100,000 for a year, you're limited to $100,000 on the PPP loan. So these first 2 guys, you're able to use some of their money for both the PPP, and then the excess, what you can't use on PPP, you're using for the ERC. So, you know, small number of employees here, but you can see how as you have, you know, the more employees, these numbers get large pretty quick, and it becomes a real advantage for businesses to be able to take advantage of this and to help keep businesses, you know, going. So I think Brent is now going to show us how we claim this credit.
Yeah, so now we know how much money we have coming to us. We want to get to it, right? So how you claim this credit, there's 2 options, if you will. The option 1 is to reduce your federal payroll tax deposits. So again, you have to have employees, so you know you're making federal tax deposits with every payroll or once a month, most likely. And then you would claim the credit on your quarterly 941. So just real quick, you know, you have your total tax line here, and then on line 12, and then line 13D comes in the employee retention credit. And then, I'm sorry, 13A is your deposits for the quarter. So 12 is your total taxes. You'll have your deposits for the quarter. Let's call it roughly 30% for conversation's sake right now. And the retention credit would be the other 70, and that's how you make up your total tax liability. So that's option 1. So you can reduce your credits or reduce your deposits going forward as you're making them. Option 2 is to use Form 7200 for an advance payment. So basically you can say, okay, I'm going to earn X amount of credit, I think, in the first quarter. So I'm going to file Form 7200 and ask for a check. And then basically when your first quarter 941 comes out, you're going to true up with what you took with what you owe. I don't know how optimal this is right now. As somebody had made the point, you know, with the post office being so backed up, you may not get that check until after the first quarter return anyway. So we would probably just want to go the route of reducing your weekly deposits or monthly deposits. Now, the other 2 clients I told you about, go ahead,
Brent,
Steve.
Yeah, Brent, I did hear that these advance payments are coming out fairly quickly from the IRS now.
Okay.
2 to 3 weeks. So it could be that, you know, it might not take that long, but, you know, you might want to just carry the overpayment, you know, forward and not use this. It depends on the situation, I guess.
Yeah, sure. No, that's great information. The other issue was, you know, the other 2 clients that had, you know, 100 and some thousand, 130, 40,000 refunds coming. I asked them, do you really want a $140,000 check in the mail right now? And they said no. So we're carrying those forward as well. But that is the second option. So that's 2021. Now, for 2020 that haven't been claimed so far, that we can go back and get, if the business has a PPP loan for 2020, the law allowed you to run the full adjustment for the whole year through the original fourth quarter 941. But obviously the deadline to file that has passed, so now you have to go back and amend each individual quarter. Keeping in mind, this is a little goofy, but they are trying to make it administratively, you know, because they allowed you the whole year here for the fourth quarter. They're saying the first quarter, if you have a first quarter amended, it would get reported on the second quarter. And that's because when the law was passed March 20 something or other, they didn't have the forms out yet. And the IRS said, okay, well, we'll just take it into account and catch up on the second quarter. So that is still within play here. So you'll amend second, third, or fourth quarter 941s as applicable. Just a note here, I think Steve said this, if you didn't include the PPP health insurance, on your forgiveness application, then you can use those costs for the ERC regardless, okay? So if you just use pure wages on the forgiveness application, if you did file that, you still have the health insurance, and as long as that exceeds 10 on an annual basis, then you can use that for the ERC. These 941s are generally due within 3 years after the original due date. So there's not an immediate rush for them. However, we'll see in a couple slides, again, we need to work this out so we know what the numbers are to actually file returns, not the payroll, but tax returns, individual and business tax returns for 2020. So this, while they're not due for 3 years, it's really kind of a pressing issue. So one last point on this slide is, you know, the payroll service, you can't just call them up and say, oh, amend my 941s, I want to take the ERC. The payroll service isn't going to know how to amend the 941s, you know, in the manner of wages and how much qualified and who qualified for what, and did you make elections, and so on and so forth. Excuse me, you're getting to a point where your CPA really has to work closely with you and your payroll service to make sure this is done completely and accurately. So, Steve, you want to take us home?
Sure. Thanks, Brent. Yeah, just to touch on that piece on the 3 years of the 941s. Yeah, we certainly, if you find out later on that you should have, been eligible for this, it's good to know that you can go back that long and claim it. But for most of you that are on this call and you would, the money right now would be helpful to help you get through this situation. We want to get that done as soon as possible for you. I know the timing isn't ideal because we're in the middle of trying to complete income tax returns and things like that, but this has to be a priority, and we want to make that a priority for you to get this completed. So speaking of tax returns, so if you do get this credit, how we treat it on the tax return, it's what under the Internal Revenue Code, it would be a 280C adjustment. So it would be a reduction. The credit would reduce your wages. So dollar for dollar. So if on your tax return, you have reported $500,000 worth of wages, and you end up getting a credit of $230,000, your net number on your tax return is going to be the 500 minus the 230 credit. And it's getting too close to lunchtime. I can't do that math in my head, but anyway, that's what, and we would show that actually as a separate line item on the tax return. So it's clear to the IRS, what is happening there. Obviously, if we reduce the wages, the income is going to be higher because of that reduction, but you're getting the actual dollars back in your pocket and only paying tax on whatever that tax rate you're at. So you still have more money in your pocket, even though you're having to pay tax on that income. So we want to certainly make sure that we consider those credits. And by doing so, we may have, extensions, tax extensions, because we need to be able to include this credit on your 2020 tax return. If you were eligible for it in 2020, you're still able to go back and claim that credit. And some of our clients, we were able to get it before we filed the fourth quarter 941 and claim it on there. And those were some that Brent had mentioned. But if you didn't claim it yet for 2020, we just go back and amend the 941s first, figure out what the credit is, and either have that credit carry forward or, get you the check in the mail. But again, it's going to be, Brent mentioned, the CPA, payroll service, work together, and the business owner. We need, especially if you have the partial shutdown, we need to go over that with you. We need to document, document the file so that if the IRS were to come back later on, we have all the information in the file that we need to show them that you did qualify. And then, it's going to take some, threading the needle, if you will, to make sure that we have the right wages going against the retention credit and the correct wages going with the PPP forgiveness application. Some other things yesterday, we just got word that Pennsylvania did allow the PPP loan forgiveness as non-taxable. Still don't know about SBA 7A payments for any businesses that had those payments made for them. And then other states issues, if you transact business in other states, we'd have to look at how they all interrelate. What we don't know yet, and I'm sure you all have heard, there's possibly some other stimulus checks that are going to come out, new tax laws. So what does that do with our tax filing deadlines? That's a good question. We don't know the answer to that yet. Hopefully we will soon. But what we've heard is that if there is another round of stimulus checks that come out shortly, then the IRS is not going to be able to do both, handle the checks and the current due dates. So we'll keep you up to date on all of that. Yeah, there's some resources that we provided here to you. You can look up all the retention credit facts, all that kind of stuff. 941, the 7200 form. It's all available at those links. And then we have Vicki, who I believe is on the webinar today. She's a director of our payroll services. So we work very closely with our payroll department in being able to, get the payroll information that we need to do the calculations. And she's right on top of things. And so if you use our payroll, that's great. If you don't, we can still get the information that we need to handle the credit.
I would just like to go on record and say that Vicki is my favorite resource of all time. So she's good. But yeah, you can see how easy it is to work together. When Chuck and I did the tax, the Biden administration tax proposal and the Secure Act, how nice it is to work together under one roof here, for our clients. So, Steve, I do have some questions. I'm sorry to cut you off. I'm not sure if you were done, but
no, that's great. Yeah, let's try to answer whatever we can.
So we have Sherry, who has asked us, were you saying that you think churches do not need to qualify for the reduction in receipts and can qualify under the government closure rule, even if they continue to have services online, and then later if they had a reduction in the amount of people allowed in the live congregation?
So I'll try to take a stab at it first, Brent, and you can hop in. So you can qualify either way under the reduction in gross receipts or the government order having a suspension in operations. Hopefully the church, the congregation hopefully continue to give as they normally would have in the past, so that you may not qualify under the receipts method, if you will, but you should be able to qualify from what we understand and how we read the rules, that you would be able to apply and use the ERC based on the suspension of services. You can't perform your services the same way you did in the past, and your operations did not continue the same as they did prior. So you weren't able to have your fellowship meetings, your children's services and all that. So you did have a reduction in how you performed your business, if you will.
All right. Wayne asks, if your ERC is larger than what you withheld weekly, does the IRS refund the balance based on the 941 reporting? And the answer is yes. You can have, again, the two options. You'll file your 941, have the difference refunded, but it's probably not going to wipe out a whole quarter going forward. It may, maybe in certain circumstances, but if you do have a refund, they'll refund it, or you can apply it going forward. Your other option is, if you want that refund sooner, you can file that 7,200 based on your projections. So, Steve, Matt asks,
and just to add that, yes, that is a refundable credit. So if you end up having more on that 941, you can get that additional cash either refunded or apply it going forward to reduce what you have to pay in for that next quarter.
all right. Steve, Matt asks, this could be a cost versus reward. Your time isn't free. Is there a dollar amount threshold where it isn't worth the trouble?
I guess that's possible. If, maybe if, in 2020, you only had one employee, so that you're getting a $5,000 credit, but it seems to me even a $5,000 credit on that small of a situation, it's not going to take us that much time to figure that out. So I would say even in that case, it's worthwhile.
Yeah, it's a really excellent answer. Those two clients that I worked with Vicky to get through, that was less than a day's work, to get that amount of money. So even an afternoon to get 5,000 is 5,000. That's a really good answer, Steve. Lois asks, how do you elect to use the PPP forgiveness first before the ERC? And I will say, I'm not sure that they came out with that direction quite yet that I saw, Steve.
I think that's one of those answers that we still don't have a good answer for.
Yeah, but I think if we get to the point, then we just do it. If there's nothing out. You made the point the other week that the IRS is still issuing guidance from 2018 items, right?
Yeah, so we, it could be years till we get it. So we, at this point, and I think, sometimes we think of, taxes as being black and white. There's always an answer for everything. And actually, most of the time, when you get into tax issues, there's a lot of gray. So you use what you know, your best judgment, and what information is available to try to make that, choice as to how you allocate things.
Okay, and I think that's it. So we're going to conclude. I will say again, I make this ask, Steve, and I did this for everybody here. If you could leave us a review on Google, I would really appreciate that. And then also keep in mind that we still are looking for somebody. So 5 to 10 year experience person, tax auditing, that kind of thing. We would appreciate you keeping us in mind. So go ahead, Steve.
One more thing, Brent, just for everybody that's on here, please feel free. You can see our contact information there, Brent's and my email, our phone number. Please don't hesitate to give us a call. We'd be glad to discuss your specific situation with you. So.
Absolutely. And as usual, we'll put out an email when this is posted to our website. You can go back and try and catch something again, or share with your fellow business owners or managers. So everybody, thank you for attending, and have a good day.
Thank you.